Paul Schatz is Heritage Capital president. He joins us now. And Paul, I mean, we're talking about kind of the highlights. Obviously, in 66 pages, it's hard to get into all of it. But I'd be curious to get your thoughts on maybe what we're talking there. Because, of course, as Aikiko noted, defending fossil fuels, you can't just kind of scrap them all. Maybe a lot of investors did that with their portfolios because the energy moves were not necessarily expected by a lot of people out there, but the strongest performer year to date. And financials, too. You heard him talking about fintech coming for their cake. So talk to me about maybe how you would be playing all this space if he, as kind of the face of financials, might be looking to acquire some of these growth names that have expanded into his territory.
There is certainly an awful lot to unpack and digest in the 66 pages, as well as just your brief conversation about it. First, big picture, and with all due respect to Mr. Dimon, and JPMorgan's one of our largest holdings, for full disclosure, I never give it too much play, too much worth it has no worth in our thinking at all. It's nice discussion topics like we would when Warren Buffett comes out with his letter. But I think a lot of what he comes out with from quarter to quarter, year to year is already in the public domain. He just kind of pulls on super popular topics. I'm glad he didn't follow through on what he said previously on the social end regarding energy. Because frankly, I think, as I've said a number of times on Yahoo, this decade, I bet a lot of money that old, boring, stodgy, gross energy beats more socially responsible, environmentally friendly energy as far as shareholder return. My worry is when people like Jamie Dimon or Larry Fink or anybody else in the banking or the kind of the big corporate space, their job, they have a fiduciary responsibility to shareholders first, not stakeholders, but shareholders. So they're supposed to do what's right to increase the stock price. And I think we're starting to muddy those waters and getting into that gray area where they become social warriors, which is great on their own. God bless, be my guest, but not if you're a shareholder.
Yeah, although, Paul, I wonder how much of their need to or their willingness to opine on these topics comes from pressure from shareholders for them to weigh in on them. Well, I'd like to get your thoughts on just what he said about the U.S. debt picture, though, because there's been a lot of concern with the stimulus bill that's already been passed, a $2 trillion infrastructure bill that's now on the table here. Jamie Dimon saying that U.S. debt is much easier, or it makes the booming economy, as he sees it, makes it easier to manage U.S. debt. And he sees just a little market volatility coming from those concerns. Is that how you see it?
No, I don't see it that way at all. So number one, you've got a couple of $100 billion left from 2020 and the Trump era stimulus. You've got 1.8 trillion already passed on the first round. You've got infrastructure coming. And don't forget, you had that Fed safety net there. So our national debt is fiscally impossible to ever pay back. As hard as that is for us to swallow, it will never be paid back by conventional means. The only saving grace we have is that the U.S. currency is the world's reserve currency. That is the greatest honor and privilege in the history of the earth. When we push the envelope into 27, 28, 30, 35 trillion dollars of national debt, eventually the globe is going to lose faith in our currency, and they will remove the US dollar from world currency reserve status. No one should ever underestimate that importance. Once it's gone, every dominant power in the history of the world, when they lose their currency, they lose world domination. And that's what I think will end up happening, not in the 2020s, but 2030s or 2040s. You'll go to a basket. We can't grow our way out of the debt problem. It is fiscally impossible. A roaring economy is great. My 21 forecast was to see an economy that could grow 6 to 8%, but then that escape velocity is going to level out, and we're going to revert back to that very kind of slow, boring growth of 2 to 3%. So no, we should not be cavalier and complacent about the insane amounts of debt we're taking on. And for him to say markets will only possibly see a small bump in the road, and again, I'm not going to disparage the world's most successful banker, but that's not a very comforting thought, that the guy who did so well in '08 is so, almost arrogant about what could happen in the markets with debt.
Yeah, I mean, it's interesting to hear kind of his throwback to what happened in World War II and the way that didn't necessarily come when you have 120 debt to GDP ratio. After that, going down to 60% wasn't because we raised taxes, but because growth was there at almost 4% for the decade. But interesting. I mean, obviously, there's a lot in this letter, and we'll definitely have you back on to discuss some of the other pieces because there's a lot we didn't get to. But Paul Schatz, Heritage Capital President, appreciate you coming on here to chat with us today.